In the 1980s and 90s, investors were just completely stunned when this whole waves of incredibly profitable companies suddenly went bankrupt overnight.
Oh, yeah, it was wild.
Right. I mean, we are talking about massive corporations showing millions of dollars in revenue on paper, yet they were abruptly closing their doors because they literally couldn't keep the lights on.
Which is terrifying for an investor.
Exactly. It turns out, a company can look like a massive success to the public while simultaneously suffocating to death behind the scenes.
And they often get away with it for a really simple reason. I mean, most people just don't know how to read the one document that contains all the clues. The corporate annual report.
Which, let's be honest, has a terrible reputation. It's usually seen as this 100-page data dump designed to put you to sleep.
True. But if you know where to look, it is actually a very detailed confession of a company's deepest secrets.
Okay, let's unpack this, because our mission for this deep dive is to completely demystify that intimidating stack of paper for you.
Yes, exactly. We are pulling from an academic guide on financial statement analysis to essentially give you a shortcut.
Right, because whether you are an investor looking for red flags, or maybe a prospective employee deciding if a company is actually stable, or just a curious learner trying to cut through the noise, you really don't need a finance degree to read an annual report.
No, you really don't. You just need to treat it like a detective solving a mystery.
I really like that framing, because a good detective doesn't just read a suspect's statement blindly, right? They cross-reference it with the actual evidence.
Precisely. And an annual report is broadly split into two halves that completely mirror that process.
Okay, so what's the first half?
The first half is the non-audited narrative. It's essentially the company's alibi. And then the second half is the hard math, the financial receipts.
Well, let's start with that alibi. The narrative section usually kicks off with the chairman's statement, right? The source material uses Hindustan Unilever as a great example here.
Yeah, that's a classic one.
Because the chairman doesn't just talk about selling soap. They link the company's performance to the broader economy. But the real core of this narrative section is the management discussion and analysis.
Right, usually just abbreviated as the MD&A. And the MD&A is brilliant in its design because it's structured kind of like a funnel.
What do you mean by a funnel?
Well, management starts out extremely broad. They'll discuss global macroeconomic trends, overall business sentiment, that sort of thing.
Oh, I see. Setting the big picture.
Exactly. Then they narrow it down to their specific industry, like what are the headwinds or tailwinds for the year ahead.
Right, right.
And finally, they zoom all the way in to detail how their specific internal divisions actually performed. So they are actively framing their performance within circumstances that are, frankly, often out of their control.
Yeah, they're setting the stage. And lately, it seems like that stage includes a lot of talk about corporate governance.
Oh, absolutely. It's a huge focus now.
The guide points out something that really caught my eye on this. It says that poor corporate governance actually increases what are called agency costs.
Yeah, that's a really crucial concept. So think about the relationship between the owners of a company, the shareholders, and the managers who are actually running it day to day.
Okay, I'm with you.
If the governance is poor, the shareholders just don't trust the management. They worry the CEO is maybe acting in their own self-interest.
Like padding their own compensation or something.
Exactly, or making reckless bets. And because of that distrust, the shareholders have to spend more money and resources constantly monitoring the management.
So those are your agency costs.
Right. Trust drops, monitoring costs go up, and the overall valuation of the company takes a noticeable hit.
So good governance actually lowers the cost of capital. That makes total sense. And part of that modern governance involves a pretty massive shift toward ESG, right?
Yes, environment, social, and governance metrics.
Right, because we're seeing strict new reporting norms from SEBI, the Securities and Exchange Board of India. The guide notes that these norms apply to the top 1,000 listed entities.
And we aren't just talking about a vague little paragraph claiming they care about the Earth anymore. We are talking about mandatory, very routine disclosures.
Like what kind of disclosures?
Companies actually have to report their energy consumed relative to their turnover. They have to detail their water usage, the percentage of recycled raw materials they use, even their gender diversity metrics.
Wow, they have to get that specific.
Yeah, and even their specific R&D spends for better environmental outcomes. The source references companies like Titan and Tata Motors, who now dedicate huge portions of their narrative to these exact hard metrics.
But wait, hold on. Let me push back on this a bit.
Sure, go ahead.
If no auditor is legally checking the math on this first 50 pages of the report, why shouldn't you, the reader, just throw this section in the trash? It's literally unaudited.
It's a fair question.
Isn't this entire narrative basically just a glossy PR brochure designed to spin a fairy tale?
Well, what's fascinating here is that even when management is spinning the narrative to sound, as positive as possible, they still kind of show their hand if you read between the lines.
How so?
In the MD&A, management is actually required to outline their threats and opportunities, and that specific section reveals their actual internal anxieties.
Oh, interesting. So they have to confess what they're worried about.
Exactly. I mean, if a company suddenly dedicates 5 pages to discussing global supply chain fragility and logistics risks, you know exactly what is keeping the CEO awake at night.
Right, even if they dress it up nicely.
Exactly. So the narrative provides the vital context you need to really interpret the numbers that follow.
So you basically listen to their alibi to figure out what they are most defensive about. That makes a lot of sense.
It's step 1 of the investigation.
Okay, let's move to the second phase of the investigation then.
Yeah.
The actual receipts. Once the story is told, the auditors step in and we get the financial statements. The big 3.
Right, the big 3. And the first of those is the balance sheet, which the text also calls the position statement.
The source uses the Infosys consolidated balance sheet as an example for this, right?
It does, and the most critical thing to understand about a balance sheet is that it's a snapshot.
Yeah.
It's taken at a single exact point in time, usually midnight on the last day of the financial year.
So it's not a summary of the whole year.
No, it just shows exactly what the company owns, which are its assets, and what it owes, which are its liabilities at that precise second. And the difference between the two is the owner's equity.
Okay, so if the balance sheet is basically a photograph, like a single frozen moment, then the second statement, the profit and loss account, or the P&L, is more like the video that explains how the photo changed from last year to this year.
That's a great analogy. That causal link is essential.
Right.
The P&L, or the income statement, covers the entire period of time between those two balance sheet photographs.
Okay, so it shows the actual activity.
Yeah, it shows the total revenue that flowed into the business over the year, minus the expenses that flowed out to finally arrive at the net profit or loss. It tracks the actual trading activities that cause those assets or liabilities to shift.
But earlier, we talked about companies going bankrupt in the 80s despite being highly profitable on paper. How on earth does that happen if the P&L video shows them making money?
Well, if we connect this to the bigger picture, it comes down to a really dangerous illusion in accounting.
An illusion.
Yeah. The P&L records revenue when a sale is made, not when the cash is actually collected.
Oh, wow.
Okay, so let's say a company sells $10 million worth of goods, but they sold it all on credit. The P&L looks fantastic. It shows these massive profits.
But they haven't actually gotten paid yet.
Exactly. The company hasn't collected a single physical dollar. And you cannot pay your employees' wages or your electricity bill with an IOU. You need actual liquid cash.
So they were profitable, but completely out of cash. That's how they died.
And that is exactly why the third statement, the cash flow statement, became mandatory after those high-profile failures.
So it's a reality check.
Completely. It strips away all the credit sales and accounting magic. It literally only tracks actual cash moving into the bank accounts and cash moving out. It shows investors if a company actually has the liquidity to survive the week.
So you really do need all 3. You need the balance sheet photo, the P&L video of the profit, and the cash flow reality check.
You can't get the whole truth without all of them.
But you can't just take those numbers at face value either, can you? This is the part of the guide that really blew my mind.
Oh, yeah. People are always surprised by this.
Because I always assumed accounting was just this objective law of physics. Like 2 + 2 is 4, but the numbers in those statements are actually built on highly subjective choices.
Yes. This is exactly where we look for the loopholes. The third major section of an annual report contains the notes and accounting policies. The financial statements give you the final numbers, but the notes break down the specific math of how management actually arrived at those numbers.
The source material uses Titan Company's annual report to show how detailed this gets. And let's look at something simple, like depreciation.
Sure, great example.
So things wear out over time, and a company slowly deducts the cost of an asset over its lifespan. Titan's notes say a building has an estimated useful life of 30 to 60 years. But a computer server, they estimate that only lasts 3 to 6 years.
Right. And to really understand the impact of that choice, you have to look at the math on the P&L.
Okay, walk me through it.
Say you buy a $100,000 server and you choose to depreciate it over 10 years. You deduct a $10,000 expense from your profits this year.
Makes sense.
But if you choose to depreciate it over just 3 years, you have to deduct a massive $33,000 expense this year.
Wow. So just by changing that one assumption in the notes, a company can instantly make their current year profits look drastically higher or lower.
Exactly. It completely changes the bottom line.
That is wild. And it gets even more specific with inventories, right? Titan makes jewelry, so obviously they hold a lot of gold.
Right.
The notes reveal that their gold inventory is valued on a first-in, first-out basis, or FIFO. But their other stores, spares and raw materials, are valued using a completely different method called a moving weighted average rate.
And again, the mechanics of that choice are huge for the financial picture.
How so?
Well, with FIFO first in, first out, you assume the oldest inventory you bought is the first inventory you sell.
Okay.
In an economy with high inflation, your oldest gold was bought at a much cheaper price than today's gold. So when you sell a necklace, FIFA lets you record that cheaper historical cost against today's high retail price.
Oh, I see. So it legally widens your profit margin on paper compared to using a blended weighted average.
Exactly.
But here's where it gets really interesting for you as an investor. If Company A can choose FIFO for inventory and a 10-year lifespan for servers, while Company B chooses weighted average and a 3-year lifespan, doesn't that make comparing two competitors completely impossible? I mean, they're using entirely different math.
Without the notes section, yes, it would be literally impossible.
So that's why they exist.
Exactly why disclosing your accounting policies is a strict legal requirement. The notes are basically the decoder ring.
I love that. The decoder ring.
An analyst cannot just look at the raw profit number. They have to read the policies, how they treat foreign currency fluctuations, how they value goodwill, how they depreciate assets.
So you use the notes to normalize the data.
Yes, so you can actually compare Company A and Company B on an apples-to-apples basis.
Well, what if they try to pull a fast one? Like, what if they just change their accounting method halfway through to make a bad year look good?
They can try, but the policies actually require them to restate the prior year's numbers using the new method.
Oh, so investors can see the actual impact of the change.
Exactly. They can't just hide behind a sudden shift in math.
Good to know. And the notes also cover some pretty juicy internal details, right? The guide mentions directors' emoluments.
Oh, yes. That's always a popular section.
By law, they actually have to show the ratio of the boss's pay compared to the median remuneration of the everyday employees.
Yeah.
You can literally see the exact multiple of how much more the CEO makes than the average worker on the floor.
Yep. It is all right there in the fine print.
Okay, so we've cracked the anatomy of a standard public annual report. We have the alibi in the narrative, the receipts in the big three statements, and the decoder ring in the notes and policies.
That's the standard structure, yeah.
But the guide points out that the rules of this document completely shift depending on who the company is.
Right, because the suspect determines the shape of the investigation, so to speak. The most stark contrast is really between a public company and a private company.
Yeah, the source outlines this pretty clearly. Private companies usually only provide the bare minimum mandatory information required under Section 134 of the Companies Act.
Because they are closely held, meaning they only have a few owners, they don't have public shareholders to answer to.
Right. And unless they are trying to secure a specific bank loan, they often don't even need fully audited financials in the same way, right?
True. But public companies, on the other hand, have their shares traded on the open market. They fall under the jurisdiction of SEBI and must comply with LODR.
LODR.
Which stands for Listing Obligations and Disclosure Requirements. It's the strict rule book that forces public companies to maintain transparency with the public.
But beyond the regulations, a public company's report is fundamentally a marketing tool, isn't it? They load it with high-end graphics and bold vision statements to attract potential investors.
Absolutely.
I like to think of a private company's report as basically a plain text grocery list you write for your family. Like, it just needs to be functional. But a public company's report is like a glossy, high-budget supermarket magazine actively trying to lure shoppers into the store.
That analogy holds up perfectly. And then, you throw government companies into the mix and the rules change all over again.
How so?
Well, for a company where the central or state government is a member, the timeline is rigid. The report must be prepared within 3 months of their annual general meeting.
Wow, that's fast.
And furthermore, it is scrutinized by the Comptroller and Auditor General of India, and then it's literally physically laid before the Houses of Parliament or the state legislature for bureaucratic review.
That is intense.
Mm.
Which brings us to the most modern variation discussed in the text, and that is the Green Annual Report.
Right. Now, this is an evolution not necessarily of the financial content, but of the physical production itself.
Right. It aligns the actual manufacturing of the document with the company's stated values.
Because the waste was just getting completely out of hand.
Oh yeah, the source cites a 2005 survey showing the average annual report was 65 pages long, and companies were printing up to 50,000 copies every single year.
It's crazy to think about.
The sheer amount of petroleum-based ink and paper being dumped into the world just to tell people how the company did was staggering.
So the Green Report changes that footprint. Companies transition to eco-friendly soy inks, for instance.
I read those are actually brighter on the page, too.
They are, and they make the paper significantly easier to recycle. And crucially, they include an eco-audit statement right inside the report.
So what does that show?
It explicitly details the physical impact of the book you are holding. You know, how many trees were preserved, the gallons of wastewater saved, and the net pounds of greenhouse gases prevented just by changing their printing process.
That's really cool.
It is, and it raises an important question about utility. The audience entirely dictates the document's form. Well, a government report is built for bureaucratic accountability to taxpayers. A public report is built to inspire market confidence for investors. A private report serves the functional needs of internal owners.
Right. And a green report is built to appease stakeholders who demand tangible environmental responsibility.
Exactly. It's all about knowing your audience.
And reading between the lines. So let's look at the big picture of what we've unpacked today.
That's good.
For you, the listener, we started with a 100-page document that looked like an impenetrable wall of jargon. But now you know the structure. You start with their narrative alibi, the MD&A, to see what management is anxious about.
Check their story first.
Right. Then you verify it against the receipts. You know, the balance sheet snapshot, the P&L video, and the lifeblood of the cash flow statement.
And finally, you look for the loopholes using the notes and accounting policies to see exactly what math they use to get those numbers. I want to leave you with a final thought to mull over, building on the trajectory we've discussed today.
Ooh. All right. Lay it on us.
We talked about how the cash flow statement was aggressively forced into existence in the 80s and 90s because traditional profit metrics were hiding the lethal reality of a company's liquidity.
Right. The bankruptcies.
Today, we are seeing SEBI making ESG reporting environmental and social metrics like water usage and gender diversity mandatory for top companies. And we are seeing the rise of physically green reports.
Yeah.
So given how rapidly investor demands are shifting, will we eventually reach a point where a company's environmental and social balance sheet is scrutinized by auditors with the exact same ruthless financial rigor as their cash flow?
Wow. That is a fascinating question. The rules of the game just keep changing.
They really do.
So what does this all mean for you? It means the game of corporate transparency is constantly evolving. The next time you interact with a major brand, whether you're buying their stock, applying for a job, or even just buying their products, go pull up their annual report.
Be the detective.
It's Agdley. Scroll past the marketing photos, find the MD&A, and check the cash flow. See if you can spot the difference between the glossy narrative they're spinning and the cold reality of their numbers. Thanks for joining us on this deep dive.